Hello and welcome to CNBC TV 18. We are counting down to the economic survey. It will be tabled by Finance Minister Nirmala Sitharaman in just 7 minutes from now. 12 o'clock is when the economic survey will be tabled in the Lok Sabha by the Finance Minister. And of course, the document serves as an important reference point for the budget, which will be tabled on Sunday, the 1st of February. So what can we expect from this survey? We've got a hint from the Chief Economic Advisor himself in a column that he's written for the Mint newspaper this morning. The Chief Economic Advisor makes it very clear, A, that this is going to be a longer than usual survey. And why is it going to be longer than usual? Because he believes that we are now in a very complex geopolitical world, and hence the survey will need to deal with many complex issues and challenges that the Indian economy faces. That's the currency, the rupee trajectory. He does acknowledge the fact that the rupee has weakened significantly in the past year, but he does say that if you look at it from a 6-year horizon, it kind of adds up to what we've seen other emerging market currencies do. But this, of course, is likely to be a talking point of the survey. He also talks about the fact that there is a need for faster indigenization. Remember, what we have seen across different sectors, specifically sectors like the defense sector, is the government's attempt to indigenize. We've seen many lines of indigenization as part of the procurement process coming through for sectors like defense, and this Chief Economic Advisor seems to be suggesting that a lot more needs to be done when it comes to indigenization. That's the vulnerability for emerging market currencies like the rupee. Cross-border capital flows become incredibly sensitive to political signals, so acknowledging once again the complex geopolitical mix. The other theme that the survey is likely to focus on is not just the ease of doing business, which was a large part of what the survey signaled last year. The survey's running theme last year was deregulation. This time, one of the big ideas is likely to be on reducing the cost of capital. A structural reduction in the cost of capital is what the Chief Economic Advisor has signaled in that article that he's written this morning. What will that result in is the big question. And the role of the private sector. Now, the Chief Economic Advisor has been saying this in public forums for the past year or so. In fact, even prior to that, saying that the private sector needs to do its bit. The government has been doing the heavy lifting. The private sector needs to stand and rise to the occasion, especially when it comes to wage growth, when it comes to nation building. So what will the economic survey signal when it comes to gross capital fixed formation? That is something that we are going to have to see. On growth, pretty sanguine. Of course, we have seen the growth estimates coming in from various agencies for the next year and the year after that at 6.4%. That's the IMF read on India. But remember, the survey was perhaps on the more conservative side, and we've seen the estimates moving towards the higher end of what the Chief Economic Advisor had estimated in the economic survey. So plenty to unpack there. We are still waiting. We're 3 minutes away from the survey being tabled in the Lok Sabha. But remember, the survey is not prescriptive. It sometimes gives you the context in which the budget is going to be presented, and sometimes some of the ideas that were presented in the economic survey do make their way into the budget. For instance, one of the big themes of the survey last year was the need for India to re-engage with China economically, and we have seen moves happen on that front. So we've seen whether it is the resumption of tourist visas, it is the re-engagement on economic fronts. We have seen that happen, and the survey was the first to call officially that there is a need for greater economic re-engagement with China. So that's one of the ideas that got taken forward from the survey. But, you know, even on this ease of doing business, there are many committees, including headed by the former Cabinet Secretary Rajiv Gauba, etc. We are still waiting for those recommendations to be made public. Whether we see that coincide with the budget, we don't know. But I would imagine that the survey will hint or at least provide a roadmap on more ease of doing business reforms. Because one of the questions that the Chief Economic Advisor is asking is, have we done enough for growth, and have we done enough to sustain the high growth that India needs? And so I would imagine some of the prescriptions in the survey will be linked to a high rate of growth that India must aspire to. Also important, AI and what it could potentially mean as far as jobs are concerned. The chief economic advisor raising that note of caution, saying India will add 8 million people annually to the job market. What happens to those people in an AI era? Remember, we've already seen automation and the gains of that for the private sector, but increasingly as we move into more jobs being done by agents and so on and so forth, are we really looking at significant disruption in the labour market? That's the big question, and perhaps we'll see the survey address that as well. We've got our guests with us this afternoon to take us through what they do expect from the economic survey. We'll of course be tracking the fine print, but let me bring in our guests this afternoon, if we do have them joining us, and of course give you. And let's go across to some of our budget editors as well as our experts. Joining us now, Sachchidanand and Shukla, Group Chief Economist at L&T, and Dhiraj, Economist and Strategist at ANZ Research. Gentlemen, many thanks for joining us here. Sachi, let me start with you. What's the big expectation on the back of what the Chief Economic Advisor has already hinted as the central themes of the survey?
So, Shireen, thank you for having me. I think it's very, very important to acknowledge that we are not even done with the first month of the year. And so much has already changed, and so much for the outlooks that people have produced. It seems everything that is coming on is out of syllabus now. So we are in a new sort of a global order where might is right. And I think that is the context. Every time we all think that we have a finger on the pulse of the macro picture, the picture entirely changes. So I think that is the context, and uncertainty is the new normal. And therefore, and also as economists, we don't typically focus so much on geopolitical developments, and what we've realized is they've become really important because of their influence on the parameters that we track and spilling over into macro forecasts and also sectoral outcomes. So I think it's very, very important that the survey or the chief economic advisor really acknowledges this particular context. And then I must also remind, you did talk about what the chief economic advisor spoke about, the Chinese supply chain. He's been very, very prescient or ominous, I don't know what to say, right? Because if you recall, last survey, he spoke about how financial markets shouldn't really outgrow the rest of the economy, the horse and the cart analogy, right? So we should be careful in terms of what we wish for. Look at the STT assumptions of 41, 42%, and we are not even having 6%. But having said that, I think there are multiple things that he's spoken about in the past, which includes the growth part, PLI, labor codes, and some of those have really fructified. Even the Chinese dependency part that he spoke about continues to persist. So I think we will be looking at some very, very important things. For example, growth. The story so far has been for the last 4 years that each time the growth numbers, actual numbers have been higher than the estimates. This will be the 4th year in a row. Yeah. Now, can we get into a medium-term sort of framework? And also, can we look at it in terms of where we want to be in terms of ambition? How does it link back to job creation, human capital, and in terms of our preparedness for this very, very volatile world? Back to you, Shireen.
Let me, before I get Lata into the conversation, Sachi, very quickly, nominal GDP, what's the number that you're going with?
It is around 10.5. We see inflation normalizing going forward. Some part on the base, food really going to normalize. Also from the global side, some bits on the metal part, and I therefore think 4-ish kind of CPI and 1.5 to 2% sort of WPI. And if you take a weighted average kind of a thing, I think with 7-ish growth, we should be able to achieve around 10.5 in terms of nominal GDP growth. for next fiscal year.
10.5, that's the nominal GDP estimate that you're going with. Let me bring in Lata and Prashant. They're joining me now in the studios as we decode the economic survey for 2026. Lata, you know, before we talk about the fine print of the survey, let's address the rupee almost at 92. And this is what is puzzling a lot of people, the kind of capitulation that we've seen as far as the rupee is concerned. The economic advisor saying that, look, it has weakened considerably in the past year, but in the 6-year window, if you take a look at that time horizon, that it hasn't done much worse than other emerging market currencies. But, you know, there hasn't been any sort of alarm bells being pressed as of today, Lata, when we talk about the currency.
Well, you know, there are alarm bells and there are no alarm bells. The alarm bells ring when an FII has to come and he knows that the very next day his assets will be cheaper. Or, you know, will go down in terms of capital value, forget a gain on it. The principal itself will shrink because of the rupee. So you can't say that it is not having any problem for anyone. Also, you know, the regular explanation is that exports will get cheaper as the rupee resets and imports will become expensive. So automatically the market will find its own exchange rate. But this doesn't always work that way because it is imports that go into exports. We have some exports like textiles and jewelry and leather, which does not depend on imports. But a large part like pharma, electronics, electricals, and electronics is becoming a giant in the trade basket, as well as, specialty chemicals, which are value added on crude. All these are dependent on the import cost. So I'm not very sure that alarm bells are not ringing. It's not to a point where, you know, we went with the Resurgent India bonds and the Millennium India bonds to attract NRIs to put more money at any rupee cost. Maybe it's not reached that point, but it is something definitely the government will be worried about. And I wouldn't be surprised if there is a rethink on the withholding tax and the long-term capital gains tax on foreigners. We cannot rest assured that the 2% current account deficit with which we have lived ever since the rupee became a market-determined exchange rate, that is from 92, we can't believe that that 2% gap will be filled by capital flows. My sense is something may come, but have you picked up anything?
Well, you know, I mean, if you go by the market opinion and the market sort of chatter, they're not factoring that in. Prashant, I know you've been having many conversations. That's not at least being penciled in. If it comes, it's going to be a huge surprise and a big bonanza, but it's not being penciled in right now.
No, absolutely not, Shireen. You know, it's one of those things which should happen. But when you put the question in a different way, that do you really think, are you convinced, or would you bet money, or, is it a high conviction kind of sort of idea that perhaps may come through? I mean, the answer is no. We've spoken with people like Samir Arora, Nilesh Shah, others. I mean, Lata spoke with Anant Narayan and others as well. I mean, so it's something which perhaps should the government should look at, but is the expectation that something will happen in this budget? I'm not very sure. The other idea, Shireen, in terms of on the taxation front, on the debt side, right? And this is a conversation that we've been having. That's the other debate. Whether the basic idea is this: you need foreigners to buy debt, foreigners to buy government bonds. Bonds are taxed at a much higher rate.
Sorry, Prashant, I'm interrupting you because we've got the first print of the economic survey, the FY27 GDP growth estimate at 6.8% to 7.2%. That's the first number. Potential India growth estimate around 7%. As we've been pointing out, the survey highlights the global environment remains fragile. Growth is holding up better than expected, but risks are elevated. Impact of global shocks could surface with a lag. Domestic demand continues to anchor growth. Rural consumption fueled by strong agri growth. Tax rationalization has led to an improvement in urban consumption. The economy is showing broad-based demand momentum. India's outlook remains positive. Trade fragmentation, geopolitical tensions, financial vulnerabilities are intensifying. India's external stability is a significant strength. Adequate buffers, manageable external position, contained spillovers from global volatility. So essentially, the geopolitical environment is what the survey is highlighting. As the chief economic advisor says, we're guaranteed a rough ride. But on GDP, the estimates are 6.8% to 7.2%. Dhiraj, your first reactions to the first numbers that are out?
Thank you very much for having me on the show. I think it's a very reasonable expectation given the kind of momentum we have seen in the economy in the last few quarters. In fact, if you ask me, our nowcasting models, which have been tracking growth at the monthly frequency, have shown a bit of a rebound in the underlying economic momentum in the month of December. So much so that, across a spate of about 40 high-frequency indicators, growth signals are pointing to about 7% growth already. So I think that 6.8 to 7.2% of kind of range is actually very reasonable, given the kind of domestic demand strength we have seen and the policy stimulus perhaps beginning to play out now.
Well, yes, the elevated risk, Dhiraj, the survey highlighting that geopolitical risks, of course, trade-related risks on account of tariffs and so on and so forth. But India continues to be positioned with a degree of strength at this point in time. Your read on the survey highlighting that we could perhaps see the impact of some of these global developments with a lag.
I agree. In fact, if you look at the goods export data from India, it's very hard to catch any definitive signal or trend at the moment. And it's true across a host of Asian economies, not just India, perhaps because there's been many factors that have played out on the trade data, for example, since the US tariffs kicked in, including the likes of front loading, which have distorted, any understanding of the underlying momentum of exports and trade surpluses that Asian economies, including India, could be earning from the US. So we currently do not know how much have, the US tariffs, for instance, bitten into potential growth of the region, potential export growth of the region. And I think some of that would become clearer over the course of 2026. It's very hard to expect that that will be a negligible amount, given the kind of exposure the region and India have to the US. But of course, there have been offsets since then, including the very strong push to export market diversification, for instance, with the EU trade deal that we recently concluded. But let's see. I think I very much agree with the point that, trade protectionism, global uncertainty remain the most, formidable headwinds to India's growth story, which otherwise looked very stellar if you think of it. 6.8 number, even at the lower end of the range, is quite good.
Okay, 6.8 is very good. And actually, we did a poll before the budget, and the average we got from economists in the street was 6.8, but 7.2 is really taking it high. And we are working on a very high base. Let's remember, we are working on a 7.5% base. Sakshi, what do you make of this number? If it is 6.8 to 7.2, let's assume that the budget will assume 7% real and 4% or 3.8% inflation, which the Reserve Bank has put out as the forecast. Do you expect that the budget estimates will work on a 11% nominal GDP? Is that the feeling you're getting from this number?
Right, Lata. So I think that the budget number could be somewhere between 10.5 or 11. I wouldn't be surprised if they work on a 11% nominal GDP number, given the range of 6.8 to 7.2 on the real side and on inflation close to 4%. I also feel that during the course of FY27, both from a CPI as well as WPI perspective, inflation could end up being a little higher than what the street or what we are currently looking at. There are a number of things that are happening both from the perspective of imported inflation, commodity prices, risk of El Nino. We still don't know whether that's going to play out or not. But clearly the direction of travel on inflation, how I see it, perhaps could end up being higher. And therefore 10.5, 11% nominal growth assumption for next year seems fair at this point.
Dhiraj, if the budget were to assume in that 11% GDP growth and the tax receipts are focused or synced with an 11-12% growth, nominal GDP growth, will the bond market be impacted? Will they look at it with disbelief? Will they react negatively?
I would err on the side of thinking so. Look, I think in a year when you're transitioning your fiscal framework and fiscal anchors from deficit targeting to debt targeting, it is very essential that your fiscal assumptions are very credible. There is just no scope for the government to be missing a nominal GDP growth target 2 consecutive years in a row. or the tax targets for that matter. And I believe that, if anything, prudence and conservatism should remain the bedrock of fiscal projections. We think that nominal GDP growth could end up around 10%, not higher than that. And tax buoyancy assumption should be below 1. And there could be reasons beyond nominal GDP that could be at play in deciding tax growth over FY27 as well, like it were in FY26. So I would think that, some of these numbers, if they're on the higher side than market estimates, could actually upset bond market participants and placate them.
Okay, well, actually, at the moment, the bond market is happy with the assumption. And what we are getting is a 2 basis point fall in the 10-year bond yield. In the morning, they opened at 6.72. Now the 10-year is at 6.7. Okay, it's showing 6.71 on the screen, but I can even see 6.70 when I look at the screen. So probably the bond market is happy that we can work with a higher tax assumption and therefore a lower deficit assumption. Before I ask the economists about the deficit assumption, Prashant, first thoughts?
I mean, I think it's all, as Sakshi said, right? I mean, it could be, as you said, 3.8, 4. We don't know what the inflation, where that will settle. Sakshi says there is upside to that. But I think, the advanced estimates for FY26 shows what? 8.8%, 8.2% growth.
Yeah.
What was budgeted back then was 10% plus.
10.1.
10.1, right? So, but this year, because of this transition to that, 1% per year debt consolidation, I think the numbers need to be maybe a little bit more extra credible. But I think from a market point of view, Lata, I think it's going to be about of course, all these numbers are extremely important, etc. But will there be things in the budget to kind of which works on growth, which works on manufacturing, which works on all those things? I think the economic survey perhaps also will have, and I'll be beyond the numbers, we'll kind of sort of read that stuff out as well. Shirin, if you want to take it forward,
No, I just wanted to comment on a couple of things. I think that note of caution is the underlying sort of theme as far as the survey is concerned. In fact, let me just read out one of the paragraphs that the survey talks about. The outlook is one of steady growth amidst global uncertainty, requiring caution but not pessimism. So that's just one of the highlights on the growth chapter that the survey is talking about. So there is a note of caution running through on account of the geopolitical risks. The survey talks about coercive action. We've seen that play out with the threat of tariffs and so on and so forth. It also says that it hopes that the US-India trade deal will conclude this year. So that is a hope that the survey is taking forward. But on CapEx, it says that it's been a good year as far as CapEx is concerned. A 28% growth year on year. That's the number till November 2025 that the survey is penciling in. But it's going to be important to see what the survey, if at all, highlights in terms of ideas to actually bolster growth and to bolster specifically private sector CapEx. That's going to be important to watch out for. On FPIs, India's foreign portfolio investment trends in FY26 exhibited volatility. FPIs were net buyers of Indian equities in Q1 of FY26 and net sellers of debt instruments. In contrast, in Q2 of FY26 and Q3 of FY26, they transitioned from being net buyers of equity to net sellers while being net buyers of debt instruments. The relative underperformance of Indian equities compared to other markets alongside trade and policy uncertainties, the depreciation of the rupee and a broad-based global risk-off sentiment amidst elevated US bond yields weighed on FPI flows. Will the budget do anything to try and reverse this is the question. Lata.
Yeah, thanks for that, pointing that out. I just wanted to point out the other paragraphs right in the preface itself, where the chief economic advisor clearly puts out fragility in the global environment as a very important factor. I'll just read that word to you. Although global growth and trade have held up better than expected, few are certain why this is the case. Hence, there is a lingering concern that the negative effects of the ongoing global political and economic turmoil may manifest with a lag. Fragility, uncertainty, and episodic shocks are increasingly structural features of the system and not episodic. He also goes on to say that the best case scenario for the world in 2026 is business as in 2025, but one that becomes increasingly less secure and more fragile. In this setting, with the margin of safety being thinner, minor shocks can escalate into larger reverberations. So it looks like the CEA at least is in no doubt that we may continue to have this lingering uncertainty. Sachin, how are you reading all that you've heard so far? One, on what may be the fiscal deficit assumptions, tax assumptions, given the 7% GDP assumption. Also, do you expect anything on the currency?
So, Lata, I think very important to note that while the chief economic advisor has spoken about a number which is in the current context of the world, 7-ish is very, very robust, but he's balanced it out by talking about the lingering uncertainty and the fragility. I just want to highlight some things from the previous survey, which are very important, which shows that even with a 7-ish number on real GDP growth, how vulnerable or unbalanced some of the economic segments are. So, for example, the aggregate GVA crossed the pre-pandemic trend in first quarter of FY25, right? But if you look at manufacturing, it had still not crossed the pre-pandemic trend. And if I were to look at the services segment, while the finance, realty, etc., have actually crossed that much ahead in say end 23, the point is the largest employer, which is say trade, hotels, transport, and communication services, which employs about 110 million people, and manufacturing employs about 65 to 70 million people. Both have not crossed, or maybe are just lagging and trying to catch up with the pre-pandemic trend. So this tells us that even in the face of robust-looking numbers, 7-ish growth, the underlying growth or some of the parameters, indicators are really lagging and fragile. It will need concerted policy effort.
Yeah.
Coming on the fiscal deficit, Lata, that you asked, I don't see a major, say, contraction in the deficit. I'm expecting a 4.3 number. I think the point is, if you are looking at a medium-term trajectory of say, consolidation, then one-year numbers don't really matter so much. We shouldn't be fussing about it. As long as the net and the gross borrowing numbers are in the ballpark that the market expects, say, for example, the gross borrowing people are expecting 16 trillion and some change, I think it should be fine. In terms of the rupee, I think, Lata, very important to understand that we need to be doing some of the right things. And again, quoting from the last year's survey, the chief economic advisor said, in a world which is very, very uncertain, there are things on trade competitiveness which is in our hands, right? So it is the state that provides governance and the private sector produces goods and services. And there is a lot to do, because if we don't really do things right, and then some of the measures I think Shireen and Prashant spoke about, the withholding tax and some of the other underlying measures, I think it is going to be a struggle. If you think about it, with a Goldilocks scenario with inflation 1% types, CAD being at 1%, fiscal consolidation, ratings upgrade, all of that, and still you don't see $1 billion a month flowing by net terms by way of FDI and FPI outflows. It calls for a deeper reflection on what we need to be doing on the economy and the policy side. At the same time, Lata, I want to caution that we should not be really showing signs of panic.
Sachin, if I can...
Because if we do that, it will be a problem on the rupee and people might take it otherwise.
Yeah, no, absolutely. You know, I just want to make a quick point. The survey seems to have revised India's potential growth rate, and we should put this out, to 7% from 6.5%, which was the number 3 years back. So even as we are...
nuanced correction, closer to 7%.
And Lata, if you go down...
Well, the sentence he says is, the cumulative impact of policy reforms over recent years appears to have lifted the economy's medium-term growth potential closer to 7%.
Okay, later down it says to 7%. So we'll work with 7, not near 7. We'll take it.
Sure.
So 7% up from 6.5% 3 years ago. So this is interesting. You know, that statement is prefaced by a comment saying, well, we've kind of sort of, this model has worked in, and it has been predictive, it has been correct, and we are now with some reasonable amount of confidence saying that India's potential growth rate is now, we are bumping it up to 7%, up from 6.5%. And of course, I mean, this is interesting, right? Because, I mean, the survey points out the fragility, the lingering uncertainty. Remember, FY26 was supposed to be, think about it, first half of calendar 2026, 2025, people were expecting a recession in the US in the second half. None of that panned out. Growth's been solid, but that lingering feeling that, well, all of this a humongous amount of news flow and trade-related threats, etc., it will show up at some point. And I think that is the fragility and the nervous sentiment that the survey refers to.
Shireen, I want to just add one more point.
Sorry, go ahead,
last year, I was going through last year's survey just to know what to expect. Last year, the CEA had advanced a forecast of 6.3 to 6.8. And in all my conversations with him, when things were very bad, Liberation Day, etc., he would veer towards 6.3. And when things looked like sorting it out, he would say 6.8. So my sense is that he's once bitten and now he's ready to be optimistic, because the actual number turned out to be way higher than what the chief economic advisor said in the survey. So maybe he's erring on the side of optimism. Go ahead, Shireen.
Well, no, I just wanted to talk about what the survey now says in terms of the road ahead. And it's also time for us to welcome our budget editor, someone who is no stranger to the budget-making exercise, also the former chairman of the IRDAI, Mr. Debasish Panda, here with us, also the former DFS secretary. Mr. Panda, perfect opportunity to get you to talk to us about the road ahead. And let me start by telling you what the survey says. It says, despite the initial impression that the world economy has weathered the 2025 shocks better than feared, the situation remains fragile. The window for business as usual or muddling through may be closing with respect to the economy, politics and financial markets. Chances of a moderate to significant disruption or a major rupture in world affairs exceed the chances of a business as usual scenario. As a country dependent on global capital flows, India has to plan for liquidity and external capital buffers in the coming year. Capital flight, including with the advent of US stablecoins, is another risk to watch out for. India will remain better placed than most in its ability to maintain a decent growth rate, but its resilience will be tested as strategic vulnerabilities persist due to external dependence for capital, energy and other critical inputs such as fertilizers. Given this risk and the elevated risk, especially when we talk about capital flows that the economic survey is highlighting, what would you expect then in terms of government action, sir? Mr. Panda.
No, let's try and understand what the chief economic advisor. I think he has painted the right picture in terms of the global optimism about India and its growth story. And I believe that we should be optimistic, but yes, the global headwinds are still on, and the uncertainties still prevail. But that gives us an opportunity also to look at things we till now we haven't. When I say that, the recent case in point is the deal which we have struck with the EU. So what essentially it tries to show us the way that, look, you have to diversify, you have to look at new markets as well. Now, the export drag to some extent will be contained with this deal, but of course we have to have newer markets. We have to tread into, and probably the US deal will also come through. So I'm quite optimistic that the growth momentum will continue. But in order to attract more foreign investments, I think a lot of reforms needs to be carried out, whether it is land reforms, whether it is power sector reforms. Financial sector reforms have happened in the past, but I think a few more steps needs to be taken even in the financial sector. Then more importantly, it is the not only the ease of doing business, but I think from the FDI point of view, the stability of the policy, the tax regime, and also it's not alone ease of doing business, but today, the global investors are looking at the speed and velocity of doing business. So there we need to, I think the government will definitely be looking at, in line with the vision of Viksit Bharat 2047 to carry out another phase of deep reforms. And I'm sure that the budget also might mention some of them as and when it is placed by the Honorable.
So what would the expectation be then, Mr. Panda, from the budget on Sunday, given the context, given the need for speed as well as the cost, bringing down the cost of doing business, and of course a further focus on indigenization and so on and so forth. Specifically from a flows perspective, what do you believe the budget can and should do? Whether it will or not is a different story. What do you believe the budget can and should do?
See, if we want to enter into new markets, we have to produce high quality goods. Now, if we want India to become a manufacturing hub, I think the MSMEs need to be given a big boost. We have to think out of the box as to what has gone wrong or what has to be done correctly in order to make the MSMEs perform at a much higher level and scale, and also the highest quality of goods to be sold in the international market. So, so there are a lot of reforms, a lot of research, a lot of understanding will have to be done. The simple things like the flow of credit into these sectors, how that can be facilitated, how the the various MSME clusters can be provided with the necessary infra that they require to produce high quality goods and they are able to export in the international market. So that is something probably the government will look at and should be doing, I believe, because there's so much of potential there to enter into these new markets. Then the other one, the reforms, as I said, land. Today, if some global investor wants to come and set up a shop in India, I mean, it's not easy to get the land. So what are the reforms that are to be carried out? I'm sure the states will have to work with the central government, or vice versa. The central government has to work with the state governments to find those kind of solutions.
Okay.
The other big thing that I would look at is the investment in the frontiers of technology.
Okay, Mr. Panda, Mr. Panda, may I just, interrupt you on that, because there is a whole chapter on that. That's why. I mean, I've gone through, I think, 30 surveys in my career as a reporter. I've never seen a chapter like this. From import substitution to strategic resilience and strategic indispensability. Now, while I have not read the entire chapter, this is chapter 16, there the economic survey seems to argue that we may have started with Swadeshi and import substitution, but now we have to get into a strategic self-reliance, a resilience in some parts. But the bigger thing is to get into indispensability. What is our rare earth? What can we hold that others can't blackmail us? So, your thoughts on this strain of thinking. Do you think that the budget will give us something to invest in a sector where we hold the cards, our rare earth?
No, I'll not talk about specifically about rare earth, but I would say
I'm also not talking about rare earth. But do you think that something will come to make us, to give us a sector of indispensability?
See, the sector of indispensability will be probably artificial intelligence, quantum computing. I think so far we have been, a center for outsourcing. But today we want to be the leader in AI or quantum computing. And I'm sure the government will be looking at these frontiers, technology frontiers, and investing in a big way, because that's the future where India will have the lead before other countries, become leaders in those areas. So I think these are some of the things that the budget will definitely look at. And of course, the global manufacturing hub is something I'm sure India will have to expand its manufacturing base and producing high quality goods. Technology, I'm sure. Agriculture will be a priority. It will continue to remain a priority. More importantly, I think skilling, which hasn't actually given the right kind of results so far. I think a lot more investment and attention has to be paid to the skilling part. So I think these are the things which I should be, and of course, health and education is something where the expenditure to the GDP has not been enough or what has been expected. So these are some of the areas I'm sure the budget will be looking at.
And, just to the point that what could we perhaps see being translated into action in the budget from what the economic survey is suggesting. And I think this is a call that has been made by many, including, of course, the economic advisor in the survey, calling for lower cost of capital over hiking import duties. Remember, over the last several budgets, starting 2014, we actually saw India move to a path of hiking import duties. There has been some rationalization that has happened over the years, but the survey is saying where upstream inputs are costly and capital intensive, lowering their cost of capital is a more efficient way to support them than and raising import protection because it preserves downstream export competitiveness. So as we've been reporting, we could expect further customs duty rationalization, perhaps in this budget, as opposed to a hike in customs duty. This will also enable, a more seamless integration with global supply chains. That has, of course, been the call as well. But Sakshi, let me get you. Yeah, go ahead, Prashant.
Sorry. Just, since we have Mr. Panda with us, I was looking whether the survey says something about insurance. And sure it does. There's a fair bit here about insurance. And I mean, the government stated objective is, Mr. Panda, insurance for all by 2047, right? We at CNBC TV18 have been reporting the effort and the focus under you earlier, and of course the current IRDAI leadership to reduce distribution costs. We heard it from Mr. The finance secretary. It was in the RBI annual report, and I think the economic survey mentions this as well. Let me just read out what it says. Of course, I mean the text is about widening distribution insurance penetration. It says high distribution costs, and I'm reading verbatim, high distribution costs are preventing a widening of the risk pool. The rigid cost structure means premium growth fails to keep pace with nominal GDP, eroding the sector's relative economic size, lowering overall costs and distribution outgoes. Lowering overall costs and distribution outgoes is essential to improving affordability, enabling the industry to tap into the missing middle and reverse the decline in penetration. So I think we've heard it from the Government of India, from IRDAI, from RBI annual report, and we've sort of reported it, on it from the time that you were at IRDAI, of course, all the way now. Any thoughts, sir?
Yeah, I think most of these points have been picked up by what we have been saying, in the last 3 years. And a lot of corrections have been made in terms of, I would say the first and foremost is to create a technology platform, to create an electronic marketplace. I think that will be the biggest game changer, because once all the players are on the electronic marketplace, which we had, thought of naming it as the Bima Sugam, which will be a digital public infrastructure in the insurance sector. So once that comes, then, that takes care of stabilizing the prices. So the market will take care, X company will, for a product will say the cost is 100, the other one will say it will be 80, the third one will say it will be 70, then it will stabilize at some point. So the distribution cost automatically will be the one, because the risk premium cannot be lowered. It is the distribution cost plus the management expenses, which has to get moderated. On one hand, I will say that the distribution cost is definitely high and it has to come down. At the same time, I would say that the insurance sector is a big, employer, or it provides employment to millions of people. So we should keep that in mind. But if we expand the pool, say, for example, one agent gets business from one person, and if that pool gets enlarged to 10 people through the electronic marketplace and the digital platform, then, the cost will easily come down, and yet that person will be able to earn what he wanted or what he should have got. So then the other building blocks in insurance are also in place in terms of the ease of doing business, the reduction of compliance burden. Today, the industry is operating with just about 18 regulations and paired with a master circular, out of which 4 are internal to the organization. So that has been streamlined. A lot of flexibility and freedom has been given to the insurance companies to design products depending on the population segment and the requirement. So a host of changes have been made, and I believe that this is an inflection point taken in the right direction. Then obviously the distribution costs will moderate, the expenses of management will moderate, and I'm sure the team at IRDA would be working on that and take it to that logical end where insurance becomes more affordable, easily accessible, and available. See, the availability is the biggest issue, and the accessibility, and the Bima Sugam will be a big boost for making this happen.
Yeah, I just wanted to, Lata, Prashant and Mr. Panda, come back to you on the rupee, because in many ways, the survey is highlighting the fact that the rupee finds itself vulnerable and could perhaps be, we could be looking at depreciation, further depreciation, if we don't actually see the requisite flows coming in. Mr. Panda, I'll start with you and then get the others. Any measure specifically you think that the government may go in for in the budget tomorrow to look at propping up, aiding the rupee?
I think the government should not be, trying to artificially, hold on to the rupee, that the market take care in any growth phase of a country. So these kind of episodes do happen. So there's no need for the panic. And I'm sure the RBI must be watching the movement of the rupee. And you see, in any growth phase, this is bound to happen. And more so, maybe the global impact also is contributing to this instability. But I don't think we need to panic. And I'm sure we will have a very stable currency going forward.
The Finance Ministry, when even we imposed that LTCG, long-term capital gains, on foreigners, and then there is the withholding tax irritant. Are you getting a sense at all that this will be rethought? There have been some solid arguments that have gone from the regulators themselves to the ministry. You think that there will be a rethink?
Well, I would think that, the equity, which is in short supply, would come from the markets. So the lot of the domestic savings overall savings is being channelized into the market. And if we look at, you have to forego that part of revenue, but if the taxes are, like, for example, the STT, maybe may not be required, because there's so much of digital, data points we can easily track. I mean, the government can easily track the movement of that money.
Sir, that's not the... I take your point that capital is available to Indian industry even if the foreigners don't come. That argument is taken. But the point is, we need capital flows to bridge the current account deficit. And that is shying away for very practical reasons. I am making a capital loss in dollar terms. I am making a capital gain in rupee terms. And still I am paying a tax. I mean, foreigners are really miffed by this. And this is coming from SEBI quarters. In their roadshows, they have been told this. Do you even suspect there is an iota of chance that these very obvious problems will be rethought?
I mean, see, the tax is something, the government will have to very carefully think in terms of what will be the tax earnings. Only then we will be able to spend that money in a productive manner, be it infrastructure, be it agriculture, be it social welfare. So yes, if you remove the tax or if you lower the tax, good for the investors. But at the same time, the government has to balance it out. And I'm sure there will be a look at these issues, and there'll be some moderation at some places to make it more attractive.
Okay. So I just wanted an academic question to you, Mr. Panda. How relevant is this survey to us trying to outguess the budget at all?
Well, the survey gives you a sense of direction as to what the government will be thinking, and how the thought process of the government and where we are going. It tries to bring out the reality as far as the global scenario is concerned, the context of the country scenario. And it sense of gives you some kind of a guidance for various ministries also to frame their own policy. It is the policy framework ultimately which will come out as far as the economic survey will provide those pointers, and I'm sure it definitely year to year comes out with a lot of interesting insights, and various departments, ministries, even the regulators look at that very carefully to design their own policy framework. So it's a good guidance or a guiding document, I would say. And help.
I agree with you. I agree with you, Mr. Panda. I think we cannot see the economic survey in isolation. We have to see it in the context of course, not just the budget, but also the policy direction that the government has chosen to take through the course of the year. And it does provide you some insights, data on the measures that have already been taken. But I think what we've seen in the last few years is the survey kind of sets the context for the budget as well. And many of the ideas, the themes, at least thematically, the survey and the budget have been kind of intertwined. There has been a convergence, whether on issues like deregulation and so on and so forth. So that is something that we need to be mindful of. The Sensex flat, the Nifty down 50 points. So we have actually come off the lows. When we started the show, we were down more than where we currently are. And we've, of course, got corporate earnings coming in as well. Sachin and Dhiraj, let me get a quick word in from you on anything else that stands out so far from the survey and what we could foresee in the budget tomorrow. Sachin?
So I think one thing that stands out for me is the argument on augmenting competitiveness of the economy by expediting expenditure on say AI, basically new age technology, AI, space, semiconductors, defense. So there is a lot of scope, and it's heartening to see the focus, because ultimately, and then Lata was asking this, what is our rare earth? I think our rare earth is the growth number, relative growth, and also how we harness our human resources towards these new age tech areas. If we are able to do that, I think it will be really buttressing the growth rate on a sustainable basis in the medium term. In terms of the rupee, I think we need to do some deep work. Like I said at the beginning, we need to dissect what is cyclical. I mean, is it only because of the geopolitics? Is it because of the global changes to the world order? Or is it something deeper in terms of our taxation, ease of doing business, and basic competitiveness and productivity of the Indian economy?
Yes, in fact, the survey suggesting that there should be a reduction as far as the rail freight rates are concerned. That's one of the recommendations. As I pointed out, one of the themes is improving the cost of doing business and reducing freight rates. Rail freight rates is one of the recommendations that the survey is putting on the table. Let me also welcome the former Finance Secretary, Subhash Chandra Garg. He's also with us. Mr. Garg, many thanks for joining us. Your first read of the direction that the survey is guiding us and what we could now expect in the budget.
So I haven't read the document. I think it has not been publicly uploaded so far. But what I see from the broad growth numbers and all, it seems to be that we are in a reasonably good space, about 7% growth projected for the next year. That's healthy on top of 7.4% growth this year. What worries me and what I would be looking at the survey is that this is the real growth. But what in terms of nominal, and more than that, what is the growth in terms of dollar? Because that is what is comparable across the world. And with this year, the dollar appreciation of about 6.5% and consequential rupee depreciation, the nominal growth of 8.8% to my mind translates into only 2.5% growth in dollar terms. That is absolutely low. And that will drive our sort of ambition of a $5 trillion economy further away. How do we see the next year in terms of that dollar kind of growth is what is also interesting to see. I would like to see whether the survey analyzes these and takes care of it. Of course, in terms of sectoral, we will look at what drives the economic growth in times to come. To my mind, the many important areas, energy transition, the digitalization of the economy, control of pollution and the climate change, how do we declog the courts and other things. So those are important areas where, to my mind, the economic growth would be impacted in years to come. How does survey deals with it? I would look at it and then comment.
Okay. Mr. Garg, good morning and thank you very much indeed for joining us. There is an important paragraph in the survey on divestment. And since that has been kind of not really performed even up to the very modest budget estimates, maybe this becomes crucial. And I'll just read it out to you. Currently, in about 30% of listed CPSCs, government shareholding is already below 60%, limiting further divestment through OFS. As it is stipulated in the Companies Act, that a government company must have at least 51% of its stake held by central or state government. Since effective control requires only 26% stake, the government could consider amending the definition of government company under the Companies Act, limited to the listed entities, to allow them to remain as government companies even with a minimum 26% stake, thereby retaining the special resolution rights while enabling the government to monetize more of its stake. What are the chances this will come?
See, this is not important to amend the definition of the government company. Government company is a sort of notional classification. It doesn't make any difference to the running of the company or the government's disinvestment. If you would recall, in 2018-19 budget, the government had come up with a proposal, and this was announced in the budget as well, that wherever required, the government can go below 51% in two scenarios. One scenario is that where 51% is lesser than the government's stake, but it is compensated by the other companies like LIC and others which the government own. And the second one was where the control is 26%, which is effective control for that. There are many companies which are run without any dilution of control if you have 26%, even lesser. So that proposal was not followed through. So I suspect that the idea is good. It's basically intended to suggest to the government that don't be constrained by 51% kind of psychology. Go below that. But that's not actually required if you want to pursue a disinvestment and privatization goal. It is the government's intent whether the government wants to do privatization.
Fair point.
There are 80%, 90%, and even 95%.
And you think the intent is lacking, sir?
Absolutely. I think the government has completely stalled and closed the disinvestment program. Look at 5 years. Last year it was 10,000 crores, not even 10,000 crores.
8,770, I believe.
Exactly. So I think as a policy, as an approach, the government is not interested to do this. You are sitting over 45 lakh crores worth of equity on listed companies alone. If you sell even 5% of that, you can raise 2 lakh crores plus. And it does not require any dilution in the sense of going below 51%. Or
Mr. Garg, yeah, absolutely. Mr. Garg, what you started with, I just wanted to ask you, reducing the nominal, the growth, the real growth minus dollar depreciation. I mean, a little unfair to compare growth rates in dollar terms. I mean, you can do it to the absolute size. Maybe that is also a stretch. But just...
If you set the goal in terms of international or dollars, that you want to be a $5 trillion economy. And secondly, if you want to compare with your peers in the rest of the world, the only fair and available comparison is in terms of the current US dollars. And therefore, if you don't do that or factor that as a kind of policy for you, then you are not actually doing a fair comparisons across the world.
Sir, but we are talking about goods, services, produced, sold, consumed in the country, right? I mean, you can look at the absolute 5 trillion, of course, in dollar terms, whenever that happens, if happens, whether that is delayed or whatever. But rate of growth, I mean, US will grow at 2.5 on their size. We're growing at 7. Yeah, I mean, we should grow faster, but...
They grew by 4% last year.
See, Prashant, this is a very interesting phase in, I think, our nation's life. This year, you're seeing that the dollar is actually depreciating against all the currencies of the world. But Indian rupee is depreciating against a depreciating dollar. It's a double whammy. Why should it be happening? I think that requires a very deep analysis. In my judgment, the policy pursued by the Reserve Bank of India to reduce the dollar reserves and to buy more of gold, to convert that, I think is putting a very large pressure on the dollar assets of India. And the dollar demand is not declining, whereas the supply is getting constrained more and more. That is driving. So whatever be the reasons, there may be other reasons as well, it need to be analyzed. The comparison has to be only an internationally acceptable. You can do it in SDRs if you like. Convert every country's sort of GDP into SDRs and then do the comparison. Result would be same.
Mr. Garg and Mr. Panda, I just want to highlight another aspect of the economic survey. And here's an interesting nuance that the survey is putting on the table. And I don't know whether this is indicating a change of heart of any kind within the government. It says the policy question is no longer whether the state should encourage Swadeshi, but how it should do so without undermining efficiency, innovation or global integration. Not all import substitution is desirable and not all forms of protection support long-term competitiveness. Import substitution is justified when domestic production is already feasible at reasonable cost, but is impeded by non-economic factors like coordination failures or legacy regulatory burdens. Mr. Panda, let me start by asking you, do you believe that this signals perhaps a change in the manner in which we've been pursuing our import substitution policy?
I think it's very much resonates with the, the vision of Viksit Bharat 2047. And obviously everything cannot be Swadeshi and everything should not be Videshi. So it'll be a right mix of what we want to import. If you don't import certain things, you will not be able to export the final product. So therefore, I think it gives some kind of a direction again in terms of the policy, which will be a very balanced one as to what we need to import and what all we should be exporting. So I think it is very, very directional, the hint you get from the economic survey. But a little more careful reading may actually tell us more what it intends.
No, absolutely. Mr. Garg, your first thoughts, sir?
See, the CAs has been making very right kind of noises in last 2 or 3 surveys. Last year, he talked about opening up to the Chinese investment. This year, this is a slight nuance to what is this Atmanirbhar or Swadeshi or self-reliance, that kind of thing. The government seems to be taking hints. I think the last 2 FTAs which have been done with the UK and the European Union suggest that the government is getting over this fascination of overprotecting Indian industry. The kind of concessions which have been offered in both these FTAs, I think is signaling that now the time has come for Indian industry to actually get ready for competition. If you compete, fair enough. If you don't compete, get out. We will align with the world. So I think that's a very fair kind of signaling. But what is more important to my mind is that the competition or the self-reliance kind of thing should be phrased in a very different kind of sort of industrial classification. To my mind, the world now is manufacturing the future goods. The goods for energy transition to solar and all, to have the digital transitions and all, electric vehicles and other kind of things. For the old economies, sort of industry, whether it's steel, aluminium, clothes, textiles, and things like that, there is overcapacity in the world. There is no longer need for more of the investment there. You look at the kind of even in the EU, our share of EU textile export is less than 3%. Even if whether we are able to get the new economy products right and their production, that would require enormous amount of collaboration with the world, the deals to be done, and especially with the Chinese and all. Shall we be able to get the new economy production right is the key to my mind. That if taking from that the signal which the CA has been sending in for years now, but the government has not been able to muster courage for that. If they do it, I think we will be in a better space in times to come. Not talk too much about this for the Swadeshi, Atmanirbharta, etc. Get on to the real business of producing goods which have a demand.
Actually, the survey talks about that, sir. There is a whole chapter on, building the strategic resilience. Page 650, actually, to be precise, where the survey talks about the role of the state itself. And it says that protection is needed in some cases, but it should be withdrawn immediately. And there's a very beautiful sentence which says, firmness ensures that protection does not become entitlement. So, the plea is that you provide protection, but pull it back. And just before that, there is a whole chapter on how to make the state entrepreneurial. Allow the IAS officer to fail and ruthlessly remove programs when they fail, but allow them to experiment. And he goes on to give examples in Japan, in Vietnam, where, you experiment, and if it doesn't work, the policy doesn't work, you ruthlessly withdraw it. Do you see any changes coming to the way bureaucracy itself is treated, sir? Mr. Debasish, Panda, you go first.
I think the protection in India, given in two forms, one by the higher tariffs, and secondly by the government subsidies of all types, actually make the industry look at the government as the giver, and wants more and more of it to be turned into entitlements. This actually makes the industry weak, in my judgment. And therefore, if you expose the industry to the competition by way of lower tariffs, as well as no greater subsidies from the government, except in the what we used to call infant industry argument or the new industry argument, so to say. Other than that, if we don't provide any subsidies to the industry, they will forget looking these as entitlements and lobby the government for more and more concessions and the subsidy support. I think that is the right course to go.
Well, my colleague Ritu has put together the word count. Remember, this is one of, I don't know if it is the longest ever, but the chief economic advisor did say that this is longer than usual. It's 700 pages. That's the economic survey for you. It mentions growth 889 times. AI or artificial intelligence 387 times, employment 305 times, inflation 287 times, jobs 123 times, FDI 141 times, tariffs 101 times, geopolitics 880 times, the United States 47 times, the rupee 26 times, and Atmanirbhar 9 times. Going back to the point that we were just making, that perhaps it is more than just a signal in terms of the policy direction that the government wants to take, is choosing to take. India wants to do more with the world. India wants to integrate much more with the world. India wants to be more competitive, less protectionist. I think the survey, if you look at the signaling as well as the direction and the word count, does seem to suggest so. We are going to say goodbye to our guests on that note. Mr. Panda, a final word from you, sir, as we come down to the budget. The one thing that you would expect the budget to do?
There cannot be just one thing, but there has to be a host of things. But I think the economic survey is a very interesting one. And once we get it, we have to go through it and maybe at a future time have more debates on that. But directionally, the messaging, the frankness with which a lot of things have put into the economic survey, I'm sure the government will take a close look and take action accordingly.
Well, we will, of course, continue this conversation, and that is what the CA says, that this survey is meant to stimulate conversation and discussion around where India stands, but more importantly, where India should be in the future. Debasish, Panda, Subhash Chandra Garg, many thanks for joining us. Prashant, the markets off their lows, in fact, almost in positive territory.
Absolutely, Shireen. When we came into this week and it was a holiday-shortened week, the first trading day was Tuesday. I mean, directionally, that is the point that we've been making, which is the fact that, we came in with about 38,000 crores in terms of short positions on index futures by foreigners. I mean, the same foreigners who were selling in cash market as well. They are, at least on Tuesday, they were the highest ever. I mean, during the depths of COVID, we did not see this kind of positioning. So it was 2 one-way. With 4 days to the budget, and now, of course, just about 1 day, 1.5 day, today's remainder and tomorrow. I mean, how could it be that you go in with, even if expectations are very low, I mean, you'd want to go in a little lighter and not heavily biased on one side, which is what it was. So I would imagine, I mean, maybe there is a little bit more to go. We are still about 100 points away from what is an important level on the Nifty. There's a downward sloping steep channel. The fall's been so sharp. So we should, if you're able to get up to about another 100 points, 25, 440 or so, perhaps, some confidence starts to return. But I guess, we don't expect too much to also happen. I mean, this overreaction on the downside perhaps has been corrected. 2 days, the market's up 300 points, and maybe let's see what we do today. But I mean, too much perhaps on the other way is also, I guess, not some things, not something which anybody's expecting, because I mean the budget is.
Spare a thought for the rupee. We've also touched 91.99, just as you were speaking. Now at 91.98, and I don't know if this is triggered by what the survey says. That, currency depreciation will remain the primary adjustment mechanism unless export capabilities are ready or are developed. So it almost seems to say that it will be the mechanism which will adjust. Yeah, go ahead.
That was what I was asking you at the very start. That we heard President Trump, for instance, say that what's wrong with the dollar being at a 4-year low. And that. Many are arguing is perhaps the Trump administration's way of enhancing competitiveness. Is, in your words and the survey's words, is this then likely to be the preferred mechanism to address the competitiveness issue?
No, we don't need to even wait for the budget for that. The behavior of the Reserve Bank and the government clearly is indicating that they want the currency to do the adjustment so that, exports become competitive or whatever, the dislocations or disturbances in the system are corrected. It is a safety valve, and that is how they have treated it. But I don't think they are not cognizant of the view that a very rapid depreciation in a very short time can be very dislocating, can be disruptive. So that may prey on them, and that may make them come with some steps. I wouldn't be surprised if there are steps, like foreign capital.
You were talking about that point about, I think we didn't get time to, but debt taxation, right? I mean, and I was just wondering, if debt, so it's taxed at marginal rate, you need money to foreigners to buy bonds, etc. But if that taxation, say you make 7% on bonds, and the taxation is at 30%, you take 30% away, bring it along with equity, suddenly your return is 5%, right?
There is a paragraph. There is a paragraph in the survey that deals with the debt markets and the need to, once again, reiterating the point of broadening the debt markets and so on and so forth. And I think there is a paragraph there that specifically talks about debt instruments and why we've actually seen people walking away from debt instruments.
But Shireen, my only point was that if they make debt attractive, equity needs help. I mean, suddenly you'll have, and I think that is something which nobody is.
I don't know if it'll
happen. I'm
telling you something, Prashant. In these cases, we must not think of it as a zero-sum game.
I completely agree.
In 1991, at a time when we were having, 3 weeks of oil, dollars for 3 weeks of oil imports, we actually brought down tariffs. Why? Because if imports come in, exports grow. So always the system doesn't work in the direction that, if I reduce for debt, then my equity suffers. It may not work like that at all. It may mean more foreign capital, more stability in the currency, and therefore more foreign equity capital.
Bonds suddenly become very attractive, suddenly, right? I mean, it's a viable option then.
Well, I don't know.
That is all. I mean,
I don't think they'll go that way at all. I've heard IAS officers, that I don't want to put that for want of time to the IAS officers who are with us, but they have maintained that in everywhere in the world, interest income is income. And that's why the government is in that mode. I don't see that changing very soon.
The other point about long-term for FPI taxation, right? If you remember 2018 when it was introduced, I remember very clearly they're saying that we have these double taxation avoidance agreements with lots of countries. So what you pay here can be set off against in your home country. Now it may be cumbersome and that is the point.
The reality is you can't set off.
Yeah, in many countries you can't.
Yeah.
But that is the argument which was made.
You can't set off because you are a sovereign wealth fund, and so you don't pay tax at all. Well, what will you set off?
Endowment, sovereign, etc.
Yeah. The market has turned positive. The Sensex is in the green, and of course, plenty of the market action will be taken forward here. We have analysed 700 pages of the economic survey. We've tried to do that very briefly, tried to bring you the most important aspects, but there's plenty more. We will digest it and then we will present it to you if there's anything there in the fine print that is worth taking note of. But, I think you've got to give it to the Chief Economic Advisor. It's It's always a credible, honest assessment of the state of the economy, and it's giving us a very clear direction, a clear path. I think we've seen that in the previous surveys as well, and this survey takes that forward. There are no bombastic sort of projections. I think it's always been rooted in reality under Anant Nageshwar, and that's sort of become his signature style as far as the economic survey is concerned. Of course, you will see him here on CNBC TV 18. With that, it is time for us to take a quick break. Don't go anywhere. We're back in a minute with all the market action right after this.
Economic Survey.